Hey everyone, this is Victoria from Adelaide Capital. Hey Rafi, we can see your screen. You're live. You're sharing it. Anyways, well, thanks for joining me today. So we're going to take a closer look at these oil markets. I've been watching the rally in the oil price and the corresponding moves in the equities. There's been numerous analysts that have been out, suggesting that we're entering a super cycle period for demand, which isn't going to be able to be met by current supply, which is going to translate into an even further surge in the oil price. So I would like to introduce our keynote speaker, Rafi Tamizian. Raf, if you want to unmute and turn your camera on. Awesome. So Rafi is the senior portfolio manager at Canoe Financial. He's also the lead portfolio manager on Canoe's 3 energy funds, the income class, portfolio class, as well as the alpha fund. Rafi, the last time we had you speaking on our platform, we were talking about why oil prices had dipped negative. And it seems like for the longest time, the story really was, oversupply, Permian shale, and then, COVID hit, which severely impacted demand. And this time it feels like our conversation is going to be quite a bit more upbeat.
Yeah, for sure. It's a big change from the last time we chatted, which was pretty much a year ago. And at that time, we were really trying to understand if the balance of control in the supply, the global supply, was going to go back into the hands of OPEC, or was it going to remain a free market? And the good news is, for us as Canadians, certainly the control went back into the hands of OPEC or the cartel, and that's what you ultimately want as a Canadian investor. So that occurred, and the ability to rebuild in this environment started successfully. And so I'm really fast forwarding beyond all that now, and I'm going to do a quick presentation here, and I'm going to run through some slides in this, and I'm going to skip through others. Total time, Victoria, that you want me to speak is what?
Yeah, probably anywhere from 15 to 20 minutes.
Okay.
And then we're going to do a Q&A at the end. So, just to our audience, if you do have questions, you can, type them in the chat or type them in the Q&A box. And when Rafi is done his presentation, then we're going to do a Q&A, and we will get to all of your questions. So if you just want to hang tight and type them in there, then we'll get to them afterwards. So Raf, if you want to share your screen, and you can go ahead.
So sharing the screen, that's a good question. Let me get it on here. Hey, Cord, I got to share the screen. How do I do that? Sorry, when I went and turned it off.
So just at the bottom, there should be a share screen button.
Oh, that's easy. All right. Thank you. All right. So this is the energy life cycle that I would have shown even last time when I was with you. We use this every time we present. We try to tell people where we think we are in the market. It's not a surprise March 2020 was capitulation. It was beyond capitulation, really, frankly. The sector traded at a valuation I've never seen in my career. Today, what's really happened is the debt restructuring went through very successfully through to about June of last year. And then we kicked off an enormous M&A cycle that is still going on today. And we anticipate, without significant moves in the equity prices, we think that M&A will continue as well. And now even the investment community is getting involved, so you can see the flight to quality and liquidity. The large mid-cap sector is very active in trading. And really what would normally happen next, and Vic, you were part of this world with me too for some time, was a new equity market would typically open up at this time. But we're not going to see that this time as readily, for the simple fact that the industry is generating enormous cash flow right now, and they just don't need new equity. They're not being asked to spend multiples of their cash flow to grow reserves per share. The market wants the companies to stay flat. It wants them to take that cash flow that they're generating and either buy back their stock or pay down dividends or reduce debt. And that's exactly what's happening. And so by the end of the year, you're going to see an enormous amount of cash built up in these businesses. And the question now is, how is the market going to value these companies with this cash? But really, the issue today that everybody needs to focus on is demand and supply. It's not ESG. It's not this fictitious story about the terminal value of oil or alternative energy. It's not the new technology of horizontal drilling and all the opportunities it brings. It is simply analyzing fundamental supply and demand. Now, this chart tries to show you two things: short-term supply on the left and long-term supply on the right. On the left, you can see the drop in the Permian, the US basins. They were the ones that were providing a lot of this short-term supply into the market, and they were making OPEC lose control of the market. And so volatility in oil prices were created by that, because oil just became a free market commodity for about 8-9 years. But with COVID and the collapse in demand, it caused these companies to have to cut back their spending for a moment. And guess what happened? The decline rate just collapsed their supply. So you can see when you add up all of the production in the US, they were supposed to be, they peaked out at about 13.1 million barrels. They're running around 11 million today. The forecast for today was going to be almost 15 million barrels by this point. So there was an expectation, if the US could have kept going and there was no COVID, that they would have been running about another 4 million barrels higher in production than where they are today. That easily could have collapsed the oil price. So you can see how the short-term shale collapse was critical. Can they come back? The consolidations are causing there to be less entities out there in the US. They're going through a rebuilding phase. And also there's an enormous awareness of the discipline that the market wants in the producers to stay flat and not grow for now. So as prices get too high here and it starts to hurt the economy, you do expect some production to come back in the short term, but they have no ability to really ramp it up the way they had it before. There were 780, almost 800 rigs running at this point when they peaked out. And the amount of capital required to get that back up there and sustained is impossible. There's no calculator that'll operate that'll make those numbers work. So we're not threatened by the short-term supply. The longer-term supply on the right, you can see these are super majors effectively that dictate the scale of this. And just the fact that capital spending is dropping so dramatically since 2014. This was the super majors reducing their capital, focusing more on things like their facilities and downstream capital spending, and some direction towards alternative energy, and their complete lack of spending on longer term projects for oil, and that have caused there to be a threat to even the medium term supply now. So you don't have short term supply through the Permian, and you don't have longer term supply through the super majors, and that means that you've got to start analyzing demand a lot more. So here's the medium term as well, the prognosis of what we think. This is a Goldman Sachs chart here, and I'll have you look at that later if you like, but you can basically see your offshore and your onshore oil production really shows a deficit of approximately 9 million barrels by 2025 in terms of supply to the market. And in terms of excess oil available on the right, that is OPEC on the right here. And in 2021 right now, we think their excess supply runs around 6 million barrels. So somewhere between 2023 and 24, we think we'll fall into a deficit of oil that runs between 3 and 4 million barrels. And a deficit in oil supply means probably more like an energy crisis created. So we do need to find some oil over the next 2-3 years that equates to about 3 to 4 million barrels, or we think we'll have oil prices spiraling up and possibly being a catalyst to create an economic slowdown. The demand side, these charts are a little noisy on the top, these 4 charts, but the bottom line here is trying to show the light green lines and the dark green lines. The light green are lower. That was last year. The dark green is higher. That's this year. And you can see basically the US is rocketing back towards their normal usage. And that was not a surprise to us. In fact, today we got even more encouraging news that their air traffic is heading back to normality as well. But what I want people to understand, and I had this on the chart, I think, when I spoke to you last year as well, is the one on the bottom here. It's very critical. The red line is the developed world. The developed world is where demand for oil has remained relatively flat for the last 15 years. The demand for energy is not flat. It's up 5-6% in that period of time, but the demand for oil itself has stayed flat. A lot of people would think that demand for energy, that increase, was replaced by alternative energy. That's not correct. It was actually replaced by natural gas. And you're going to have 2 groups on next. Crew is one of them that focuses on the natural gas side of things. And I would say anybody producing natural gas in North America today is in a very good position with both the LNG exports and the amount of infrastructure we're building to use natural gas. And so our increased energy usage is being offset by natural gas. The undeveloped world, the blue line, that's different. They don't have the infrastructure nor the gas to be able to offset their increased energy demand with natural gas. So they have to use oil. And there is a very robust demand for oil in those areas. There is not an alternative for them. The alternatives, we keep trying to be postcards in the developed world for the alternatives. And what we get is things that happened in Texas, or what happened in California, or what happened in Europe. California in the summer, Europe and Texas in the winter demonstrate that we're just not ready. The affordability of these alternative strategies is nowhere near where these undeveloped worlds can use them. The reliability of them is nowhere near. I mean, in the U.S., in Texas, it got a little cold and they had a cold shower. In the developing world, you have those problems and you get mass carnage and death. So that's not going to happen. You can see here the vast majority on the left side of usage is still coal, oil, and gas. All of this talk and the airwaves we hear about windmills and solar panels, and they contribute all of 1.8% of global energy involvement. We got to get over that story and start focusing on how to attack these problems the right way. And it's certainly not with windmills and solar panels. You can see on the right here that the vast majority of the population is in Africa and Asia. And so those are the places where the developing world is. And you can see from the chart before I showed you, that's where the most of the demand growth is coming to. So the demand for oil is healthy. The supply is waning, and it sets the sector up very nicely. In terms of the markets, here's your bottom line here is the representation of the sector. It's crawled off the bottom from 2% of the S&P. It's now kind of closing in on 3% of the S&P. And so it just isn't an influence in the market in the investment community to necessarily feel like they have to be a part of it. A lot of people think they shouldn't be investing in the sector, but some people just don't think they have to right now. And as a result, it's kind of sitting there in the weeds with very few investors really focused on it right now. And that is actually an opportunity. It allows almost this recovery to happen in somewhat in slow motion. And I don't want people to think that this market's gone too far too fast. The valuations of things, the sector is still very healthy. And in Canada, I think what it's really important to understand as well is when you start focusing on our energy index, you can see that over 70% of the index is represented by 5 names. And in fact, the amount of oil and gas companies in the index have dropped dramatically in terms of the numbers today versus where they were a mere 4 years ago. So you can focus on these 4 names, the Pipes, Enbridge, and Trap, and Pembina. Then you've got Canadian Natural and Suncor, the 2 big oil sands players. But really, I would tell people to check out the large cap and the mid cap sector. 2 of the darlings in the group are going to be speaking right after this again with Kelt and crew, and recognize that the amount of exposure the market has on them is so little that you can be playing in this space without a lot of competition right now. Also, this chart kind of shows you what's happening. Here's some of the largest fund companies on the left in Canada, and this is as of December 2020. But they and the capital that they have exposed into the energy sector, and you can see on the right in the red box, the vast majority of their investment is stuck in those core names that are representing the index. So they're index hugging is what's happening, and the rest of the names are being ignored. And what I'm going to show you here, to my point about has the market gone too far too fast, and this is kind of the piece de resistance of the whole presentation really, is that red box kind of shows you that group that is in the index, and using oil prices at $60 and $70. And remember, $70 oil, I don't mean a point in time. $70 oil would be what we think the oil price is going to average between the middle of this year and the middle of next year. And based on that, what do these companies trade at when they if we use their average historic valuations using $70 oil? Well, that group that is in the index probably has about a 70 or 80% return ahead of it. That's not bad. But if you move into that intermediate sector, you can see that there is still between 250 and 300% return in that group. Crew is one example. If it trades at its average historic valuation at $70 oil, and you'll be hearing from Dale right away here, that there's a 500% return in that stock going forward here. So very lucrative for him. Kelt is coming up right away. You can see that's a 300% return to its historic valuations. Although Kelt does look a lot different than it did the last time it was in the market up there. But you'll be able to hear from them and see what kind of dynamic is going on there. A few other names in the presentation here. I'm gonna leave it there, and but there's some private equity names and some alternative energy exposure that our funds carry. These are some of the larger positions as well. Tourmaline and Paramount in our fund. Trican is energy services. What happens invariably when these companies generate a ton of cash, it means there is going to be some pressure to start to spend more in the field. The energy service sector has been decimated in this correction. And so any amount of increase in spending, you're going to see pricing power through the service sector. We think the first place that's going to come is the pumpers. And that's why we strongly recommend looking at something like Trican and maybe even STEP. Here's our portfolio and our subsector exposure that we currently have right now in terms of where we sit on our income fund. The energy class, really our focus right now is crude oil, energy services, and gas really are the focus for the group today. So I'll leave it there, Vic, and happy to take questions, or if you want me to sign off and go into the Q&A, I can do that as well.
No, we have some time, so let's do some questions live. I have some questions too that I wanted to start with, but I mean, thanks for the presentation. I think a lot of our audience and a lot of generalists, have really stayed away from the sector given the extent of the downturn. So it's just helpful to get an update on what the supply demand picture really looks like now, because it has changed quite a bit, from where it was when people left the sector. And I also found it really interesting just to see, how upmarket a lot of the large institutions are and have become. It just seems like there's a lot of missed opportunity right now in some of the smaller names. So
I think there's a lack of, I mean, Vic, better than anybody, um, the intellect around analysis and sales of the sector has been ripped out of the guts of the system in Canada. You left the industry. There are multiple people of your caliber that left the industry. The analytical side is very, very weak. And it's just the simple fact that there's a lot of pressure in the system to not be focused on that group. And the funny thing is they're not focused on it, but the usage has never been higher of oil. And so it just bodes very well for these businesses as a result.
So I guess I'll kick off a few questions and then we'll try to get to some audience Q&A as well. But, I think everyone's watching the economic recovery, and, most of the major oil demand centers have really gotten past the worst of their COVID flare-ups and are coming onto the other side positive. But then everyone's watching CNN at the same time, and you're seeing India and all of the problems that they're having over there. So does that worry you at all, or does that push back your timeline on when we would see kind of this surge in demand, or is it just demand so strong elsewhere it's not going to matter?
Yeah, no, that's a good question, because what I actually, another way I say it is, where is the downside in this thesis that we have? And there are these aberrations in things like what's happening in India. The market has been brushing it off. I think there's a little bit of breath holding right now to make sure that India can start to recover here and get the right focus. It's going to take a monolithic process to do that for them. So we are watching to see if it affects demand in the short term, but the market is really shrugging it off to this point. And it's just really, and it's shrugging it off in the sense that it's looking beyond it. The question is, how far is beyond, and how long will this linger, and will it start to kill the demand? We've seen no indication of that as yet. But I would say the biggest the risk to this sector is demand destruction. It's not some aberration on supply. Hopefully, I went through it very fast, that people will not fear that there's a supply shock coming somewhere. I would say, if anything, it's how do you erode demand substantially enough that you can cause there to be an oversupply. And this massive infrastructure spending globally that's going on, it's unprecedented, and it is a complete with complete disregard for the usage of oil. Oil is massively required for this infrastructure spending, and it's skyrocketing the demand for it currently. But if we get an economic slowdown, a massive economic slowdown, a day like yesterday in the tech sector, does it drag into the rest of the sectors and then take everything down? And is this finally the last leg in this long economic cycle that we've had for so long in the growth markets? It probably would have corrected had they not had that infrastructure spending. But as a result of that, that's the equivalent of, on a ratio basis, probably something similar to what happened in World War II in the spending that went on and created the economic boom after World War II. It's not dissimilar to that. And so it's revitalizing the economy and keeping things going. But that's, I would say, the biggest concern I have is not necessarily India. It's at what stage of the global economic cycle are we at? If there's a downturn, it turns down demand and you see weaker prices then. But I think we got bigger problems than oil and gas at that point.
And then how are you thinking about this push for deurbanization? And, everyone's moving out of the cities, everyone's got, new homes that they're buying, they need to heat, they need to furnish, they're now driving everywhere. Whereas before, maybe, they walked from their condo to the grocery store.
Right.
So how big of an impact is this going to have? This is almost a new pocket or an expanded pocket of demand that
Yeah,
isn't much new.
not many people ask me that, and it is something we're working on actually to try to understand it. It is material. Car sales are through the roof. Used car sales is through the roof. The supply chain is broken, which is preventing all of that to get accentuated even more. We think if the supply chain wasn't broken like it is right now, you'd see even a more elevated amount of demand. You see a lot of the rural towns around the big cities starting to pick up in real estate, and people staying closer to home. And so we really just feel like there's an unknown amount of pent up demand that's developed from COVID as a result of people moving out of the inner city and into these rural areas. So that's something we haven't been able to predict what that number will be, and we think it's still on the come.
Yeah, I mean, I live in the suburbs, and I always say I only go for a walk when I'm going for a walk. Like everywhere else, I have to drive. So, but
Yeah.
it'll be interesting to see. And then I do want to get to some audience questions, and there are a few, around just the Permian and the supply side that you talked about, and in terms of, what do you mean by the market kind of wanting them to stay flat? And at some point, if we do see this surge in oil prices, it almost becomes unprudent for them not to try to grow. And so maybe just a little bit more clarity, since you did go through that section.
Well, first of all, I think this is the first time in my life and career, and I see Sadiq and Dave are on now too, and these guys are what you would refer to as thoroughbreds. Typically, the industry charges forward, spending multiples of cash flow to grow reserves per share. And that message from the investment community was loud and clear last year in North America, and to curtail that growth. And I'm not saying that I think that was a good idea. I think actually that was a bad idea, because I think that North American oil, and specifically Canadian oil and gas, is probably on a human rights track record basis the best oil and gas to produce in the world. And by vilifying this oil and gas in North America and trying to tell these companies to suppress that growth while the demand continues to grow, it means we're putting more and more control into the hands of these countries that are producing that we might refer to as dissident nations. And as they get more control and power of that oil, they're going to start to use that as a vehicle to get things they need. And that's going to create geopolitical risk. And so there is no geopolitical risk value in the price of the commodities either right now. And that is a further elevated amount of pricing increase that you will get. So at some point, that pressure has to come off, and they have to recognize the importance of Canadian oil and gas to the global market. And that's when I think you'll start to see pressure to see this sector start to expand its production. That might require different governments at that point.
Okay. And I do just want to read two more audience questions, because I think probably a lot of people are wondering the same thing. So the first one I'm going to read is, I hold two Canadian juniors. Both of them are generating free cash flow, but they're still trading at less than 2 times operating cash flow per share. So what is going to draw investors into this grossly oversold sector?
Well, two juniors, first of all, like I said earlier, early in the cycle, there's anxiety around investing. So there's flight to quality and liquidity. And so you see your integrated large cap intermediates. And it's not until later in the cycle, when people want to elevate their risk, that they start to chase the juniors. So that's number one. You've just got to wait for that group to go. Number two is not all cash flow is equal. Okay. You increase service costs by a certain number of value, and some of these companies, their free cash flow will fall substantially. Others won't. Others also are drilling up all of their inventory. A company that's got free cash flow today with a 3-year inventory is not going to get the same value as a company with free cash flow in a 15-year inventory. And so don't get too caught up. There are some people that talk about this free cash flow like it's a homogeneous thing. It's not. I would encourage people to go on Canoo's website, and my partner Dave and I did a free cash flow analysis webinar. It's about 20 minutes long to help people understand that not all cash flow is created equal. And I would advise you to go look at that and see the story, because I think it'll help you understand that, you know, not all of these things are created the same way. But but in the most generic sense, these companies are pumping out cash flow, free cash flow yield. And 30 years in the business, I've never said that word before. This industry doesn't do that typically, and so they're bringing down their debt, as I mentioned. They're increasing distributions, and you know what I tell a lot of the producers, and I would tell Dave and Sadiq, and I would certainly tell Dale as well, amongst others at Crew that you're going to speak, that as an investor in energy myself, I have no interest in them trying to spend money to figure out how to get new investors. I'm more interested in them taking that money and giving it to me. Distribute it to me, make your yield go higher, and make yourself look more, incent people to invest in you by chasing the stock price higher and the yield down. And I get the benefit from that. I don't think we should be trying to figure out how to convince new unit holders who don't want to be in the sector and vilify it. I'd rather that capital be distributed back to me in my hands. So at this 10 seconds, I'm more interested in the companies paying down debt and distributing capital to us, as opposed to trying to expand capital and production with that cash flow. It's a problem, and it's a good problem that producers have, to have multiple opportunities to use their money right now.
Okay, Rafi, last question, and then we do have to move on. So this is the last question we're going to answer live, but then Rafi is going to hang out and he's going to answer the rest of your questions in chat. So don't think that your question's not going to get answered. But Rafi, what would change your bullish view? What would you need to see?
Change my bullish view would be fear that the broader market is materially aging and rolling over, and actually, like, I'm not talking about the tech sector rolling like it did. The tech sector might be rolling, but it might be transferring over from the growth to value market. Like I said, infrastructure spending by governments is so robust right now that we feel like this global market economic slowdown is mitigated by all of this infrastructure spending. But my biggest fear is obviously demand destruction, which I don't think can really come from any other way but a global market slowdown. So for those people who are very supportive of the market right now that are listening and think that it has legs, you should have a material exposure to your basic raw goods and inflation products, and oil is one of them. For those who fear the market right now is overly robust and toppy, I don't think you should be. I think you should be hiding from pretty much everything right now, frankly.
Okay, thank you so much. I appreciate your time. And like I said, he's going to hang out and he's going to answer some of those questions in chat. So Raph, if you just want to turn off your camera and maybe unshare your screen.
So I stopped sharing. Yeah, all right.
You just stop sharing and then just hide yourself and you can type in chat.
Bye-bye.
Bye. Thanks again. Okay, so our first presenters today are going to be David Wilson, the President and CEO, and Sadiq Lalani, the Vice President and CFO of Kelt Exploration. So Kelt is an E&P whose assets are focused primarily in West Central Alberta and Northeast British Columbia. I think their track record speaks for itself in terms of accumulating large resource style plays at very low costs where they see potentials to earn high rates of return. So this is a team that sold their previous company, Celtic, to Exxon years back, and they recently sold a large Montney package at Inga to Conoco. So I'm going to pass it over to them, and they're going to walk through, what they're up to now. So Dave and Sadiq, if you guys want to unmute and turn your cameras on, there we go. And then, hey, and then Dave, your camera is still off. But I think he's unmuted. There we go. So which one of you, which one of you guys are going to screen share?
I will screen share it, Vix, and
Perfect.
I'll maybe kick off the presentation as well, and then Dave will join in as well after.
Okay, that's great. So I'll turn my camera off and I'll go on mute and I'll leave it to you guys. And then when you guys are done, I'll come back on and we'll do a Q&A as well.
Perfect. So I think you can all see the screen. Happy to be here, and thank you, Adelaide, for hosting us today. So for those of you who are not familiar, Kelt has been around now for about 7 or 8 years. We started the company back in February of 2013 when we sold Celtic to ExxonMobil. Part of that sale transaction, we spun out about $140 million worth of assets into a spinco, and the Celtic shareholder would have received cash and shares in this spinco, which became Kelt. So over the last 8 years, we've built Kelt up to a significant production base and a very significant land base. Just like Vic mentioned there, we tend to use downturns to our advantage and pick up land at low costs, and we pick up large tracts of land, which ultimately does attract significant buyers like Exxon in the case of Celtic and Conoco in the case of our BC Inga property. Currently, we're still, as a public traded company, we're probably still one of the top Montney landholders out there. We have over 370,000 acres of Montney rights, and we also have over 74,000 acres of Charlie Lake rights, which is another pretty significant play that people are quite active in these days. Our target, obviously, value creation, try to achieve a 2 times or better recycle ratio on our CapEx spending. And you'll see in the slide later on that management and directors are significant equity owners in the company, so we're aligned with all of our shareholders. We did come out with an ESG report in January. This is something that we've always been targeting. However, these days, I think there is more disclosure on ESG, and we've got a separate ESG report that people can see on our website. Our capital structure, we're just under $500 million market cap, and currently no debt. After the sale of that Inga property, we paid off all of our debt. We redeemed our convertible debentures and currently have, a positive working capital of just over $20 million. As you can see from this slide here, directors and officers do own 19% of the company outright, and we've participated in just about every equity deal that the company has been involved in. And you can see from this slide, we've also been pretty active in the open market. Since we started the company, in addition to the shares that we rolled over from Celtic, we've put another $135 million of our own money acquiring shares either directly from equity issuances or in the open market.
Hey, Sadiq, I'm sorry to interrupt, but when you're going, I don't think the shares are or the slides are changing on our side.
Oh, they're not, eh?
Like we're still on your value creation slide.
Okay. Maybe what I'll do is I'll just...
Oh, that's changing. There you go. Now we're on your capital expenditure slide.
Oh, perfect.
Okay.
So you can see that now?
Yeah, perfect.
Okay. So on the capital expenditure slide, we came out with our budget in November of last year and recently increased it to $120 million. This budget will see us spend a significant amount of money on drill and complete, more so than as a percentage of total than in previous years. You'll notice in previous years we had a pretty high infrastructure spend. Obviously, some of that was due to the big facility we built at Inga, but we also were able to build good pipeline infrastructure on our Alberta assets. This year's facility budget of $38 million, the majority of that is to build a facility at Oak in BC. And we'll show you that when we get to the Oak slide. So if you look at kind of the inventory of wells right now, we've got a pretty significant inventory of wells that have either been drilled and completed or just drilled. In the drilled and completed category, we've got 3 Wembley wells and 2 Oak wells. In the DUC category, we've got 2 Wembley wells, which actually just got completed here in the last 2 weeks. So those would be completed now. We've got 8 Oak wells that are waiting on completion, and that completion program should start in June of this year. We've got a DUC sitting out in our East Oak lands in an area called Flat Rock. And then we're actually completing our 2 Charlie Lake wells, the Spirit River Charlie Lake wells. And as of today, they might actually be completed, but those are underway right now. So quite a big inventory of wells to bring on production. And then during the remainder of the year, from May to December, you know, we're on a pad right now at Pouce-Coupé, and this would be kind of an oilier part of our Pouce-Coupé play. You'll recall from our press release that we talked about 2 Pouce-Coupé wells that came on in Q1. They were high deliverability gas wells, both capable of over 10 million a day. They've been on production now for a couple months, and these 3 wells are actually east of the gas wells in the oilier part of the play. And then we also have plans to drill and complete a Wembley well, which we will tie in this year. And then we've also got 3 more drills at Wembley that currently are just slated for next year's completion program. So with that, when we did have the Inga property, we were producing about 30,000 BOEs a day. In 2020, we closed the sale of that transaction to Conoco for just over $500 million. And it closed in August of 2020. So this 24,900 BOEs a day would reflect about 8 months of Inga production. After the sale of the Inga assets, we were about 15,900 BOEs a day. We reported just over 16,000 in Q4 of last year and just over 18,000 in Q1. So you can see the trajectory of growth is there. And you know, we're currently forecasting a 19,000 average for the year. With respect to commodity prices, you know, our commodity price assumptions are a little bit below where the actual market is today. We're assuming WTI prices of $59.95 for the year. WTI is trading kind of 64 to 65 right now. And then on NYMEX gas, we're forecasting 282 for the year, and NYMEX is kind of trading above 295 these days. So we've got a little bit of room in our production forecast for commodity prices. On the gas markets, you'll notice when we reported our Q1 results, we ended up with a pretty nice gas price, realized wellhead just over 375 an MCF. And you know, part of the reason for that is just the way we diversify our gas markets. We've got about 21 million a day of gas going to the Dawn market down in Ontario. We've got 6% going to the Chicago market, and then the balance, you know, 10% at Station 2 and 55% at AECO in the Western Canadian markets. We did hedge some production here, and you know, if you were all listening to Rafi's presentation earlier, you know, I think we're on the same page as him in terms of where we think oil prices are going. So we haven't actually got any hedges that go past September of this year. We've got oil production hedged until September of 2021. And then we've actually got some gas hedged also till October of this year. And when we released our Q1 results, we reported another 15 million a day of gas hedges at NYMEX at 367 Canadian per MMBTU for 15 million a day. That goes till October as well. So that's over and above what we have in this slide here. As far as sensitivities go, even though our production is weighted more to gas, we're about 60% gas and 40% oil and liquids. A 10% change in the price of liquids and gas actually has a bigger impact on liquids. You can see, a 10% change in the price of oil and liquids would affect our cash flow by 8.6 million bucks, or 8%. And a 10% change in the price of gas would affect our cash flow by 6.6 million bucks, or 6%. So what does that mean for netbacks? We're actually thriving to reduce our costs here. And after the sale of Inga, you'll notice that our royalty rate moved up from 5.2% to 8.5%. We had a pretty lucrative incentive program on our Inga asset. Now, we are bringing on 10 new wells at Oak this year in October. And when that happens, this royalty rate should drop from 8.5%, probably down a couple percentage points. And the reason for that is we've also done a deal with the BC government where part of our infrastructure spending at Oak, we will get back about 37% of that on 49 million bucks worth of spending in royalty breaks from the wells that we bring on. So we will see royalty rates come down if you were to look forward to 2022. The transportation cost is pretty much driven by the gas markets that we have. Some of those markets going to Chicago and Dawn. As we bring more gas production on, and they probably go to the local Western Canadian markets, the transportation expense per BOE will come down, and the operating expense of $9.60 a BOE. Once again, with the production adds in the fourth quarter, we expect that to drop down to $9 a barrel, or even lower. Most of our netback is going right to the bottom line. As you can see, no interest expense here, go forward with no debt. And G&A currently at about $1.40 a BOE, which is still pretty competitive compared to our peers. But as we bring new production on, we should be able to bring that below $1 a BOE as well. This year's forecast summarized here, revenue of 238 million bucks, cash flow of 107, or 56 cents a share. And with that 120 CapEx program we talked about earlier, we would leave the year with about a $7 million positive working capital and still no debt on the books. As far as reserves go, we did issue a press release back in February of this year with year-end reserves. And if you exclude the Inga assets, which is what this pro forma column does, you will notice pretty significant increases in reserves, about a 20% bump in PDP reserves, and a 13% bump in proven, and a 12% bump in 2P reserves. The mix is, on reserves, it's about 42% oil and liquids and 58% gas. When we did run the reserve report, the independent engineers that do the evaluation for us is Kroll, and their price deck was pretty conservative. It was probably reasonable at the time, given where oil was trading at that time. But they're using 46 WTI for the first year, 48, 53, 54. If we were to look at this 4-year strip today, it would be closer to $60 a barrel. So quite a bit higher. And as you know, you get most of your NPV in the first 2 or 3 years. And so these prices in the early years would make a difference with your NPVs. But using this price deck, the NPVs for the company on PDP was just over 200 million bucks, on proven was 430 million, and for the 2P case, just under $1 billion. Looking at the FDC that we have booked in our report, and what FDC is basically a future development capital program. In our 2P case, we've got 132 Montney wells booked, and you would have to spend 730 million bucks to drill and complete and bring those wells on. And then in the Charlie Lake and some other formations, we've got about 42 wells booked in our reserve report. These numbers here, as you will see when Dave presents, are just a fraction of what we actually have in inventory on our lands. So there is lots more inventory than what's booked as future capital in the reserve report. This is a busy slide on finding costs. It includes the disposition of the Inga assets. I'll move on to the next one, but it's a bit more meaningful. So if we exclude the Inga assets, last year we spent 150 million bucks of capital, 82 of which was spent on Inga, so we removed that. So on total capital of 68.3 million bucks, we added about 10.7 million BOEs of PDP reserves for a cost of 640 a BOE. And this year we're forecasting netbacks of about 1680 a BOE, so that gives us a 2.6 times recycle ratio. I think we were probably one of the very few companies that actually had a better than 2 times recycle ratio on PDP reserves last year, but they're hard to find and it's hard to do, but we're happy with the results that we got. At this point, I'll turn it over to Dave and we'll just continue the presentation with some operating updates here.
Yeah, good. Thanks, Sadiq. Can you hear me okay?
We sure can.
Yeah. Okay. So Kelt is predominantly in the Montney play here. You can see we've got 3 main operating divisions: Oak Flat Rock, Pouce Coupe, and Wembley Pipestone. They're all big Montney areas for us. In Pouce Coupe, we also throw in Progress and Spirit River, where we've got a lot of Charlie Lake lands that we're, as Sadiq mentioned, we just have currently been drilling that and just finished fracking a couple wells on that. The Grand Cache area is a pretty dry gas area where we haven't been doing a lot of drilling here lately, and we're just using that as a cash generator to help finance these other plays. So this land fairway that you have in front of you is our 3 main operating divisions. Again, Oak Flat Rock, that's in BC, up just across the Alberta BC border, and then we've got the Pouce Coupe Spirit River area right on top of the Wembley area. You can see we've got a very large holding of lands here. We currently own 906 sections, of which 579 of those are Montney. So like Sadiq said, we're one of the bigger Montney players. And what we've managed to do here is set ourselves up in the oilier part of the play. So as you go east and north on this Montney fairway, you typically get oilier, and that's what we've seen with these plays. And I mentioned we've got some good Charlie Lake lands, specifically in that Progress Spirit River area, but also down in the Wembley area as well, where a couple of pretty big dispositions actually have occurred here in the last month or two. So this slide, what it demonstrates is just the amount of opportunity you have within the Montney. So, in most areas, you're anywhere from, say, 150 meters thick to 250 meters thick. So you're actually thicker as you go west. Where we're at in Pipestone, Wembley, we're probably around 150 to 200 meters there, but we still have 4 zones that we're going to be developing in Wembley Pipestone. At Oak, on the west side there, we've got 3 zones there that we'll be developing as well. So this just demonstrates the magnitude of this Montney play. For every section you've got in some areas you've got 4 different zones that you're going to develop. So we'll jump into British Columbia first. So we've got our Oak property, like I mentioned, just across the Alberta border. This is a huge chunk of land that we have just, got started delineating. We drilled 2 wells about 3 years ago and put those on production. The one down at the bottom there, 14 of 11, that's been on for about 3 years. And then also there's a well up in that cluster that's 13 of 13. It's been on for about 3 years. Real happy with the productivity of these wells. And the only problem we've had here is we didn't own our own infrastructure. So to that end, we've started a big program here. We've drilled 10 wells in total. 2 of those are completed. We're going to complete the other 8 here starting in June. And at the same time, we're going to build a battery over at 6 of 35. You can see it outlined in yellow there. And these wells will all be tied into that battery. From there, it goes into this big pipeline that it already exists there, 16-inch pipeline, which takes it to the McMahon gas plant. So, we're in real good shape here from a facility standpoint, from a gas plant standpoint, and a pipeline standpoint. Once we get our own battery built here, and we expect to have that built in September, and then kind of with a on production time of October 1st. So moving into Alberta, you can see we've got not quite half of our Montney lands in Alberta. We've got this slide just shows you specific Montney rights. If you layered in the Spirit River lands, this would be a much more contiguous piece of land. But what we've done here in the Pouce Coupe progress area is we've put in all the infrastructure, and we're just currently drilling these wells up here and bringing them on production. So there isn't much to do infrastructure wise there. And then down in Wembley Pipestone, it's a newer property for us that we started developing about 3 years ago. And we've just lately finished our 3rd battery down there, and got a little bit more pipe to run, and it'll be to the point where it's to a development stage as well. So here's that bottom chunk of land that was on the last slide, Wembley Pipestone. You can see we've done a pretty good job of delineating this big land base. It's about 169 net sections, so big. The biggest piece of Montney in the area. So we're I think the next biggest piece may be Ovintiv, or no, sorry, it's Pipestone and then Ovintiv. So we're pretty proud of this land here, as it like I'd mentioned previously, it's in a very oily part of the reservoir. So you can see that the EURs, so that's the total production that's going to come out of these. It's based about 55% oil and NGLs. So you can see that anything in green, the printing in green, that's wells that we're drilling this year. In a lot of cases, they've already been drilled. So this is the same map of the same area. However, it just shows the infrastructure that we've got. So there's actually 3 different gas plants that we produce to. The Sexsmith gas plant, which we own a small interest in. Wembley gas plant, kind of in the middle of the land base. And then Pipestone Tidewater gas plant down at the bottom there. I mentioned that we've just finished our 3rd battery here. So we've got one at 1 of 14, the one at 11 of 31. It's the one that we just finished, and then we've got one up in 14 of 29. Now what we do here is we try to put the batteries where we actually can drill water injectors so that we can lower our production costs. And that'll be the case in all three of these areas. We've just got one more to drill on our 1131 battery. And then the only other infrastructure or major infrastructure that we're going to have to put in here is about 15 miles of pipe that will tie in these new wells that we've drilled off in that main part of the block there on the eastern side of the block. So that'll go in the first half of next year. So jumping into the Charlie Lake play, I'd mentioned that there's been a couple of fairly major acquisitions out here, and just kind of demonstrating the quality of this play. You know, there was, I believe this last land sale, land up here was going for $1 million a section, just north of here in Mulligan on that Charlie Lake play. So, you know, it's a play that has very good economics. You know, it's quite oily where we're at here. Some as you go farther east, actually, it gets a bit gassier, but the stuff that we're drilling is typically quite oily. We've got about 95 wells here in our inventory. So I think Sadiq mentioned that we're actually just fracking, completing a couple of wells. They're actually in this middle block here at Spirit River, the 8 to 25 and 1 to 25 wells. Those wells, like he'd mentioned, we're just in the middle of completion and probably bring them on in July sometime. Probably two of the better wells that have been drilled on this play are actually at the bottom of the map there. The two 301 wells. One is in the upper Charlie Lake, one's in the lower Charlie Lake. And you know, as it says in the slide, the lower actually paid out in 5 months here. You know, at not dissimilar prices to where we are now. Actually, I think oil would have been a little bit less than it is now, and gas would be right around where it is here right now. So very economic play. You know, I think we're going to demonstrate that with these next two wells, and we'll continue to drill this play off to the west here through next year and the year after on that western block. So you know, we've got numerous drilling opportunities here go forward, of which we've pretty much delineated most of them, with the exception of Oak, where we've got some more delineation drilling to do. So we're going to very quickly go into a development mode here, where we won't be spending money on infrastructure, or not very much infrastructure, and you'll see us, you know, doing a lot of development pad work, which, you know, is much more efficient than delineation work that we've been doing. And you know, we've pretty much got as much land as we need or want, and as much inventory as we can handle. And you know, we plan to continue to be a build and divest company. Like Sadiq mentioned, we last year we sold one of our properties to Conoco for $500 million, and that's what we've set this company up to do. We've got the three main areas that we can sell any one of the areas at any time, and do it in a pretty tax efficient manner because of the way we've set up the company. And you know, in that case, we probably do a return of capital to shareholders. So I think we're probably pushing the time limit here, so I'll just turn it back to Victoria.
Yeah, no worries. You guys started a little bit late too because of Rafi. So I do want to get to a few questions before we move on though. So first of all, congrats on the quarter. So volumes looked really strong. Everything seemed like, you know, it beat the street's expectations. And you guys are in such a unique position having net cash, which really affords you the flexibility to set your own pace for capital allocation. So I guess my question would be, how are you guys thinking about your capital spending and your pace of growth in this commodity environment?
Yeah, I think so. At $65 oil, all of our areas have tremendous economics, and we're a little different than like you said, a little different than 95% of the rest of the companies. Whereas we've got way more inventory than well, you never have more inventory than you need, but more than we can actually put capital to. So the way we see value is by drilling up this inventory and showing the value of each play, and then getting into a development stage, and at the same time getting some pretty good cash flow returns. So we're gonna take advantage of our balance sheet and continue to grow the company at a fairly fast pace, but you won't see us taking on big levels of debt. We'll do it in a real prudent manner, and expect to see a pretty good sized company here in a couple of years from now without, like I say, without running up the debt.
So an audience question that had been sent in prior to your presentation. So they were asking about your infrastructure build out at Oak later this year. Are you guys going to need to finance in order to build a gas plant? And if so, given your previous experience, would you look at doing convertible debentures and a combination with equity?
Yeah, no, I think we've got that total build out is within our budget this year. So all that infrastructure money is actually in our budget this year, and we're going to end up coming out of the end of the year with positive cash in the bank there. So won't need to do any financing. I would say go forward that probably will be the case there, unless something out of nowhere happens there. I don't think we're going to be doing a lot of financings.
And maybe just one more thing there, Vic, on Oak.
Yeah.
In your question, you mentioned gas plants. The way our Oak property is set up, we're building a gas compression and oil battery facility on our lands, but we've actually got a firm service deal with a third-party midstreamer. It's North River, and it's called the McMahon Gas Plant. And so we don't actually have to build our own gas plant. We've got a deal with North River to take all of our gas to McMahon. There's two big pipelines that go right through our Oak property, and McMahon currently has quite a bit of spare capacity.
Okay. Yeah, no, that's great. So staying on Oak, you guys have such a large land package there. So when are you guys going to be able, do you think, to speak to your expectations from a growth and inventory standpoint? Do you guys need to wait for those 10 to 12 wells to come on later this year? Are you looking at providing, inventory numbers or?
Yeah, I think we'll need to do a little bit more development or delineation off to the east there, Vic. We've kind of right now we've focused the current development in a real oily part of the reservoir. We think it's very oily just from the offsets that we drilled. But yeah, we'd like to get these 10 wells on production for call it 2 or 3 months. That will give us a real good indication of what to expect there. We expect we can go east across the river there and have similar type targets, but in all reality, we need to do a bit more delineation drilling out there before we start pounding the table on how big the inventory is. But so far it looks, we're really happy what we're seeing.
And then, you guys talked about this in your presentation as well, but historically, your MO has been to find, build, and sell these resource style plays. So how much more delineation at Oak or say, Wembley, do you think is going to be required to get these assets to that threshold?
Yeah, so at Wembley, you're a little further down the cycle there. So we've got, like I mentioned, we've got most of our infrastructure in place there. We'll be running about 15 miles of pipe to tie a bunch of the wells in the east part of the block into facilities, but don't have a lot more infrastructure there. So we'll kind of be on a development phase there, call it by mid next year. So you're at that point, all you're doing is just developing and increasing cash flow from the property. Now at Oak, it's a little, we're like you've alluded to, it's a little further down the road, and realistically, Oak would be a good property to kind of be really ramping up into kind of 23, 24, because that's when the big LNG off the west coast is going to come online in hopefully in 24 there. So that would be a great time to have this delineated and be into a development phase there, where you might have a real good audience there for wanting to buy something that could deliver gas to that LNG project.
Okay, so we do have to move on, but I might email you guys a few extra questions just to get answered for people, just in the interest of time. But thank you so much for your participation. It was so great to have you guys on and get an update. I haven't heard the Kelt story in a few years, so it's nice to hear what you guys are up to and that things are still going well.
Perfect. Thanks, Victoria.
Yeah, thanks.
Okay,
Victoria.
thanks so much, guys. Thanks, Sadiq.
Yeah.
Thanks, Dave.
Yeah, bye-bye.
Okay, so I'm just going to introduce our next presenters. So we have Dale Schwed, the president and CEO, and John Leach, the CFO of Crew Energy. So Crew's activities are primarily focused in Northeast British Columbia, where they're developing their world-class Montney asset. This consists of a large contiguous land package of over 264,000 acres. They're currently underway on a 2-year deleveraging plan. It's already off to an extremely strong start. So, I mean, we think it's a very exciting time for Crew, and we think you could see a substantial increase, in their stock price given their deleveraging activities and combined with the commodity tailwinds as well that we're seeing. So I'm going to ask them to turn their cameras on. Perfect. And then you guys will be able to screen share as well. So it just should be at the bottom of your screen there. And then once we get your presentation up, you guys can start, and then we'll come back at the end with Q&A as well. Okay, perfect. So it says that you're sharing your screen, but I don't see, oh, there we go. Perfect.
You see everything, Victoria?
Yeah, we see everything,
Yeah.
and I can hear you great. Okay, I'll leave,
Great.
and then I'll be back in a few minutes.
Okay, fantastic. So I'd like to thank Adelaide for hosting today's conference. And got a few slides to go through here, so I'm going to get started. Obviously, the slide kind of depicts what's been happening in the industry over the last year. Things have come back really, really nicely from the depths of the pandemic last spring and summer. So good to see the commodity prices recovering. So the cautionary statement, you can read at your leisure. Some key defined terms that we put in here for some that are not used to some of the terminology we use. And let's take a look at why we think Crew is a good investment in today's energy world. I think that we really tried to focus on everything on this slide, and I won't get into a lot of the details. I'll just basically talk a little bit about the highlights, because we'll talk in detail in the rest of the presentation about some of these things. But obviously the macro setup is very bullish for nat gas and oil right now. Crew is very well positioned to participate in that energy transition, having about 75% of our production natural gas. Also, when you look at Crew as from where we were to where we are today, we were just over 21,000 barrels a day in Q4 as an average. Now in Q1 we were 26, so that represents over 20% growth. And if you take a look at our cash flow this year, we should be probably increasing it by over 180%. So that is obviously a function of increased production, lower costs, and more importantly, higher commodity prices. If you look at our resource, it's obviously large at 265,000 acres. Our net asset value based off of our reserve report is anywhere from $9.66 to $15.43. I think more importantly, when you look at what we've done over the last 3 years in adding value, we've added reserves at a cost of 15 cents an MCF as an average over the last 3 years. So that's very cheap additions for reserves, and obviously generates high recycle ratios. Market access, we do have access to the 3 U.S. Destin pipelines, in addition to future LNG access. The optionality we do have to sell down assets. Again, we have a $37.5 million option to sell down 11.43% of our infrastructure, meaning 2 gas plants. Liquidity is looking good. We've got lots of liquidity, $150 million bank line, and about $75 million in debt and working capital in the quarter. So lots of liquidity there. Our commitment to ESG, I'll speak to in a bit of detail at the end. And obviously, we're aligned with our shareholders and bondholders, and the fact that in the top 65% of the top 20 shareholders are insiders, meaning 13 of the top 20 are insiders. So, and we have been buying a lot of stock over the last year. Here's some Q1 highlights. And again, if you take a look at this, I think it really depicts where we started the year, and at the end of Q4 as well, where we were able to essentially drill a number of wells, 7 wells in particular in the 9-5 pad that averaged over 5,000 barrels a day for quite some time. Average production in the quarter was 26,258 barrels, up 21% over Q4. Operating costs were down, which is good to see, down 12%. Our cash flow was up materially, up to $34 million. As you can see at the bottom of the screen, it's up from 15.6 in Q4 and steadily increased from last year. Again, a function of higher production, but more importantly, commodity prices have come back. We did spend $50 million, which is a little bit less than we expected to spend in the quarter, drilling 11 wells and completing 6 over that period of time. And you can see operating costs definitely going in the right direction, down. As far as participating in the energy transition, what we have in terms of how we're coping with what's going on, particularly in the world, and as the world transitions to more renewables and natural gas, we think that natural gas is going to be a very important piece of the puzzle going forward, and the fact that it really has a base load for energy needs, and that really is critical, because we believe that, and I think everyone else does as well, that without natural gas, renewables will not be relevant in this day and age. And as a testament to that, the IEA is forecasting gas production and demand to increase over 33% by between now and the end of 2050. So that's a big step. And if you take a look at the renewables, it's roughly around the same amount. So gas and renewables are going to grow in lockstep going forward. And obviously, everyone's talking about hydrogen, but it is a very, very important part of blue hydrogen going forward. If that is going to be an energy source. Just another slide illustrating that by OPEC. Natural gas, they're projecting 24.3% increase in natural gas demand between now and 2040. And then if you take a look at us participating in energy transition, and Rafi spoke to some of this stuff earlier, but I think short interest in Canadian energy stocks are at 5-year lows right now. Capital inflows in ETFs number 1 since 2019. So clearly there's been more attention being paid to the industry in the last little while. Obviously, we'd like to see more of it, and we'd like to see more attention also paid to some of the smaller cap companies, as he also spoke about.
Hey, Dale, I'm sorry to interrupt. The bottom of your slide is cut off just a little bit. I'm not sure if you can blow it up on your screen. We just had someone message us.
Okay. sure if Chris is listening to this. I'm going to keep going because I'm not sure exactly what.
Okay. Yeah, just keep going. It's fine.
Okay.
Yeah, I could come in, get it on my screen and come in if you like.
Go ahead.
You're going to have to unshare.
Stop share.
Yep, please. All right. How's that? Everybody see that? Is that
Yeah, that's perfect.
working?
Yep, that's great.
Okay, great. So on the slide, clearly, we're just talking about the reserves and what they're worth as far as a per share basis. That relates to the $9.66 to $15.43 we talked about at the end of 2020. And as far as our recycle ratio is concerned, we were 6 times on a PDP reserve base in 2020, which I think is probably one of the better ones in the industry. Clearly, I've talked about the low F&D over the last 3 years at 15 cents an MCF. And, when we take a look at the land that we have in the Montney, it is really, really well situated strategically in between the 3 pipelines close to the Coastal GasLink pipeline. So, we believe, and we took a look at this and said $1,000 an acre, but much of the land in our area has been going for $5,000 plus an acre. So if you use the $5,000, you're coming with $15. If you use $1,000, you're coming up with that $9.66 per share. So lots of latitude to move around between those 2 numbers. Next. Okay, so on the reserve highlights again, just illustrating. Last year we didn't do a whole lot. We just drilled some because of the COVID pandemic. And Q4 we put some production on, which really helped our F&D, obviously, and increased our PDP reserves from 63 million BOEs up to 67 million. Go ahead, John. In terms of the economics, what we've really seen, and this is quite an important slide and one that I'll talk about a little bit here. If you take a look at where we had booked reserves in 2014 versus 2020, at that time we were drilling wells roughly a mile long. Now we're drilling them 2 to 3 miles long. And the efficiencies around that are shown here by the capital. Capital is essentially the same drilling 2-mile laterals today as it was drilling 1-mile laterals a few years ago. In addition to that, the frac technology that we're using is far more advanced and more effective. And we're able to touch more of the rock when we do frac it. Because of that, you're getting a higher IP rates, and that sort of doubled where we were then. You're getting more reserves, and obviously you're getting much more value generated on a PV basis, on a per well basis. So, some of the things that we're doing that are different, obviously, we're able to stay in zone more than where we were 5-6 years ago by using rotary steerable technology. In addition to the fact that we are able to frac these wells more intensely, using more sand at less cost, just because of the efficiencies around timing of the fracs. Next. That 9-to-5 pad we put on in December, it's about 68% paid out at the moment. So and obviously a benefit from fairly robust gas prices in February, but and you'll note that we did have a high gas price in Q1 at over $5.54 an MCF, which I think is probably one of the highest I've seen to date. In terms of infrastructure, it supports about 100% production growth in our production over the next anywhere from 2 to 4 or 5 years. We got a 40,000 BOEs of capacity, and we want to grow from about 22,000 in 2020 up to around 32,000 average in 2022. which constitutes about a 45% growth rate. Next. Okay, in terms of in margins, you can see here that we have been steadily improving our margins, and you saw that in one of those first slides when we showed that our operating costs in 2000 or in first quarter were down to 465 a BOE. When we take a look at this, that includes the operating costs, which are going to come down around 25%, transportation around 30, G&A 15, and interest around 25. And I think it is important to note that we are shedding around $9 million of annual transportation fees this year, at the end of this year. Next. Take a look at the production growth. Again, we $41 million last year. We're suggesting, based off of pricing today and production, that we're forecasting 115 million this year and around 150 million next year. There's the sensitivities on the right to gas and cash flow. In addition, I think the sort of name of the game these days is paying down debt and generating free cash flow. And one of the things that we are doing in this plan, obviously, the plan is to take advantage of our infrastructure, the infrastructure that is being unutilized, so we can optimize production through that infrastructure. That'll drive margins higher, and in the end, will drive free cash flow. So what we're factoring right now is on strip pricing, we should have free cash flow next year of anywhere from $55 to $75 million. Here's our hedge book, and again, I think one of the things that I can say is that we were very fortunate in the first quarter to be exposed to some of the markets that we have been exposed to, particularly the Chicago market. What we have seen in the last couple of years now, we've been in that market for about 6 years now. I think about 4.5 of those years were pretty good. When the Nexus and Rover pipelines came on from the Marcellus and Utica that connect into that market, we saw pricing deteriorate over that period of time. And for the exception of that one February cold weather, prices have really been down quite a bit in that market. So as a result of that, we've kind of pivoted away from that market, and you'll see here that AECO is going to be the bigger market for us here in the foreseeable future. But we do have the optionality to get back in some of these markets down the road. We're about 55% hedged for our gas production this year at 308 an MCF, and about 35% next year at 305 an MCF. And again, this is all part of the 2-year plan to ensure that we have the cash flow to execute that plan by doing some active hedging. Let's take a look at the optionality here. Many of you know that we've bought and sold many properties over the course of time. We've raised over $700 million by selling properties since 2010, and we do have an option to sell another piece of our gas facilities at about an 11 times multiple for $37.5 million that we have not exercised to date, but that option is available to us until June 30th, 2023. On the liquidity side, we do have plenty of liquidity, as I discussed earlier. The leverage metrics, that's something that's obviously we're very, very focused on, in the fact that we do have higher than our peer group leverage metrics. And one of the reasons we undertook this program is to get us back on side with that. So you can take a look, we're at 5.5 times debt to cash flow, or EBITDA to cash flow, or net debt to EBITDA, sorry, in last year. We expect to be net debt to EBITDA anywhere between 1.7 and 2.3 now in Q4 22. And that's changed from about 2 to 2.5 times we had in here in the last presentation based off of higher commodity prices. So definitely the leverage metrics are getting into a place where we're happy. I think at the end of the day, we'd be happier in that 1 times or under. Next, John.
Is it not advancing?
Yeah, it did now. Thanks. Okay, so in terms of our resource, I think we talked about that. There's a number of the shale plays around North America. One thing I will say about the Montney in the area that we operate in for for most of the part in the Montney, it is not a shale. It's typically a siltstone or a sandstone, and more behaves like an unconventional reservoir. So when we do see lower declines out in longer life in the wells, they don't sort of go straight down in terms of declining. They level out at a certain decline rate. And right now, wells we haven't drilled in Septimus for about 4 or 5 years, we've got an 11% decline rate there. So you can see here, our declines are in that 28% range. Usually in the shale basins in the US are around 50%. One of the things that is unique about the Montney, it has really good to excellent reservoir characteristics, fracks quite easily. And obviously fracks, if you can frack wells easier, then you have lower costs doing it as well. So economics are important. And really, I mean, one of the problems with having gas in Canada is you have to get it to market, and it costs you quite a bit to transport that gas. The good news is, from a Canadian perspective, is that the low royalty structures that we have make up for what we have to pay in transportation to get these products to market. Next. Here we go. There's this is a slide. I think most companies have this slide now, and it's really what it is depicting where we have potential prospectivity and where we have drilled most of our wells. In general, I'll just say that at West Septimus, the go-to zone for us has been the B zone, and we drilled a lot of wells in that zone. And as you go to the southwest into Groundbirch, the A and AA zones become the more prolific zones in that area. So we just drilled 3 wells in Groundbirch, and we will be completing those wells. I'm very excited about what we've seen in the pilot hole there. So that will be coming at some point this year. In addition to, we drilled a well at Attachie to hold land there. 3 wells we did drill at Groundbirch were to hold wells there as well. And we do believe there's significant lower Montney potential in the Tower area, where there's been some offset activity that has yielded some very good wells. Next. Okay, this depicts our reserves that we have booked. We have relatively a low number of sections booked on our lands here. You can see it's 19% in the upper Montney and less than 1% in the lower Montney. Really just illustrating lots more potential and Tower especially, now that there's a lot more activity around there, drilling wells in the lower Montney and in the upper Montney that we can access. So that for now, the focus of our drilling efforts has been closer to our infrastructure, which is in West Septimus. Next. Okay, this is West Septimus. You can see there's a number of wells on here. I'll just focus on a few of them. The 9-5 pad is the one that we put on at the end of 2020. And that pad it has performed exceptionally well. It's 68% paid out right now, and we expect about a 7-month payout on that pad. Next is the 1-8 pad that we've drilled and will be completed this year. And then we have also completed the 332 pad, where we have gas condensate, higher condensate rates, just under 500 barrels a day average per well for the first 30 days. So happy with those condensate rates. And then also the 414 pad, which is a 9-well pad that we have currently. We had drilled 2 wells on that pad in April, and then we'll put the rig down until probably late June, and then start the rig back up again to finish the other 7. So lots of activity going on here. Right now we have about 10 ducks that we have in Q1, and then we drilled 2 more in Q2. So about 12 ducks available to us at the moment. Next. Okay, this is ultra condensate rich area. Again, just a blow up of that slide that we just saw below. I think really what we want to focus on here is the fact that just on 17.5 sections of land, we have an NPV in our reserve book of $609 million. And many of you know that's under our enterprise value today. So I think that, again, a great proposition here for value and the exceptional wells to date as well. You can see on the right, we're expecting payouts in that 7-month range again on these wells when you take a look at the prices that we're seeing today. Next. Septimus. Okay, we have not drilled wells in here in a number of years, and you can see on the bar chart on the left, there's capex and then cash flow. So the big year we drilled a number of wells was in 2014. Clearly that was a while ago, and then ever since 2016, that asset has produced free cash flow to the tune of about $150 million. I think the other thing that is indirect on this slide is if you look at the gas price that we achieved through that period of time versus AECO. So you can see the AECO price in blue, and then that's the average price for the year, and then our price that we achieved in the pink. Clearly, after 2015, our marketing efforts were rewarded by going to Chicago. In 2020, that reversed, where AECO was a better market than Chicago was, and as I pointed out too, it's really because of the Nexus and Rover pipelines accessing that market and providing more competition. Of key here importance is once these wells have stabilized and you don't have any offset fracking, or you're putting new wells on that have 60% declines, you're looking at 11% decline on this asset at the moment, which is more like a conventional reservoir. Next. Okay, this is other opportunities that we have. We do have other land that's not on this map, where Dave and Sadiq were talking about their lands at Oak and Flat Rock. We have about 55 sections of land up in that area. We haven't really done anything with that. We're actually very keen on seeing the results that they have and others in that area. So that's great. And at Attachie, we have roughly around 45 sections in what I would consider to be the liquids rich area, which where the name Attachie is, and then down to the south, that's Portage, and that is less liquids prone. And then obviously Groundbirch, we're excited about the potential there, and very close to the Coastal GasLink pipeline. We've got some fairly significant wells that have been drilled around us more recently by some other operators in that sort of 10 to 15 million cubic feet range. So excited about the potential there as well. Market access, again, there are the three pipelines, Alliance in blue, and you can see the TC system there, and then the Enbridge system in yellow. We're right in the middle of it all. And Coastal GasLink down to the bottom, you can see there that is very close to our development at Groundbirch. So we believe that we could be an excellent source of gas for LNG Canada. Okay, in terms of sustainability and ESG, we are very focused on this. Obviously, I mean, it is something that we and the industry is really focused on. And obviously, you all know about how Canada fits in the world. We're in the top three in terms of our ESG scores. In addition, that we are coming out with our inaugural ESG report this summer, so we're excited about that as well. Next, John. Okay, again, freshwater use and hydraulic fracturing is way down for us. It's down 91%, now only what 4% in 2019. We're just getting our 2020 numbers together now. And gas plant flaring, you can see, is down 71%. Spills are down materially as well. We're using a lot more natural gas for running the frac crews as well, so we're saving on emissions on that going forward, and we're also looking at electric as another source. And one of the things that we were, I think, the first in Canada to do was we used a spoolable pipeline to transport water during frac operations for two pads, the 9-5 pad and the 3-32 pad. And if you were to take a look at the number of truckloads we saved, it was over 7,300 two-way truckloads that didn't happen because we put this pipeline in place. In addition, that would equal to about 4 times the circumference of the globe. So in terms of truck travel, just for fracking one of those wells. So very, very progressive. And now we're hearing that other companies are trying to do the same thing. I'm proud of our team. who went to the BC government and OGC and pitched the concept and got their approval for this. So it has worked out extremely well for us. In terms of safety performance, again, lower than industry average and trending in the right direction down. Safety is extremely important to our crew, and it's something that we focus on a lot, and you can see it's starting to show, and it really does show in the total recordable incident frequency, as you can see there. Next. In terms of the clean energy, as I mentioned, we are in the top 3 as far as Canada is concerned. It is somewhat disappointing to see the U.S. come up with 11 BCF a day of LNG production that's being transported offshore when we started our first LNG project before they did, and we still don't have any LNG off the coast of British Columbia. But when we do, the good news is it'll take the equivalent of 18 million cars off the road, and obviously displaces higher GHG emission sources of energy like coal. Next. Okay, and we did talk about this earlier, but I think it is important to also emphasize is that we are, as a crew, as a member of the crew, we are shareholders and bondholders. We do engage with our shareholders quite regularly. Unfortunately, with the pandemic, we haven't been out as much, and actually at all. We've been doing more of these types of conferences and one-on-ones online. But definitely, we are poised to get going once the pandemic is over, and can't wait to get on to see our shareholder base. One of the things that we have done more recently, we added another person to our board. Gail Hannon now takes us to about 36% female representation on our board. And we do have a board refresh with David Smith retiring this year and Gail coming on board. So that's our average board tenure is about 10.2 years. Highlights again, I won't really get into them. It's basically on the same as we talked about in the beginning of the presentation. But what I think we can offer shareholders is growth and value at a very, very reasonable price, since we're trading in the dollar range and have an asset value of over $9 and growing over 20% in terms of production and over 150% in terms of cash flow this year. So we are looking forward to completing our 2-year program and getting our balance sheet in shape so that we are in that sort of 1.7 to 2.3 times debt to EBITDA, and look forward to executing on this program. That I'll take, John and I will take questions.
Okay, yeah, thanks for the presentation. So congratulations on the quarter. It looked very strong, and it seems like your deleveraging plan is off to a very strong start. I know Rafi mentioned it at the beginning of the presentation, but just looking at the sheer opportunity in owning Crew right now, I think he had it at around 500% as you guys, deleverage, increase the margins in your business, and then you guys have this favorable commodity backdrop behind you. It seems to me people could do quite well in your stock these days. So I guess my question is, after this 2-year plan, what does Crew look like on the other side of it?
Yeah, so we want to get to that sort of 33,000 BOE mark. And as I said earlier, we have 40,000 BOEs of capacity. So if we could grow at kind of 10%, 5 to 10% into that, get the balance sheet in shape. And obviously one of the things we have to do is refinance our bonds. So that is something that we're focused on. And we think once we get our debt to cash flow or debt to EBITDA in the right position, that we'll be able to do that. And our bonds have really reacted well to this plan, and the fact that they're up about 45%. We were trading in the 60s. Now we're at about 93 this week. So definitely going in the right direction and getting in the direction that we would be able to refinance at some point in time.
Is the plan then to just refinance them using debt again, or would you look for a combination of debt and equity and reduce the level?
Yeah, I think, well, one of the things we're sensitive to is dilution, obviously. I mean, if we saw a material increase in our share price where, we thought it was at a level that reflected reasonable value for the company, we would definitely entertain that. But we have no no reason to issue equity in this market at this point in time. We're more focused on the debt and how we can finance that.
Yeah, I also think that with the positive cash flow that we're seeing and the commodity prices strong over the next couple of years, there'll be an opportunity to bring down our debt. Obviously, we're focusing on, our plan shows us free cash flow for next year. So, there'll be an opportunity just through cash flow and free cash flow to bring down the debt levels over the next 2 years, and we'll see where that takes us prior to refinancing.
And then a question I had, but an audience member actually asked it as well. So I'll make it into a bit of 2 parts. So you guys talked about, some of your other areas and the optionality that you guys have. So would we look at kind of those other areas as non-core and assets that are potentially for sale? And then the audience question saying, are you guys actively pursuing sales of any of these assets right now? Or just how are you thinking about that part of your business?
Yeah, I mean, I think some of our assets have been for sale for years. Obviously, we still have a heavy oil asset that we had tried to sell a few times, and we thought we had sold, but we didn't. And so that is perpetually for sale. I think the other asset that we would look at is everything north of the Peace River, really. And so that would mean Attachie and Oak Flat Rock. Would be something that we would entertain, and potentially Tower as well. I mean, we want to focus our efforts where our cost structure is low, and we can drive margins higher. And that one, even though it is oil, just the cost structure is not as good as it is around Septimus, West Septimus. So that's something we would have to work on if we were to develop it. But those are the 3 that we would definitely be interested in selling. And part of your other question is, are we actively looking at selling some of these things? We have some interest in some of these assets right now, so we'll see where that goes. You can never say it's going to get done, but it's good to see that at least there's some interest.
And then do you guys have any expiries on any of the land that you guys have to deal with, or it's just all mostly held at this point?
Yeah, so the big, great question, because this first quarter is where we really solved a lot of those issues for ourselves, because we drilled 4 wells that held about 62 sections of land. So that was a big deal for us. We drilled the 3 at Ground Birch, and then we drilled the 1 at Attachie. So that's behind us, and so we're happy about that. And what went along with that was drilling the 3 wells, obviously Ground Birch, which we think could be highly productive.
And then you guys have this, ultra condensate rich region over at West Septimus. So how many locations do you guys think you're going to get there?
Yeah, so right now in the reserve report, we have about 50 locations booked. So that's going to change all the time, because what we're doing is we're drilling these wells. Initially, we're at 1 mile laterals, and now we're 2, and now we're going even like 2.5 to 3. So the numbers are not necessarily as indicative as, the amount of production we think we can get out of that area, because the number of wells are going to be reduced with the lengths that we're drilling these wells at. But right now, there's about 50 in the reserve report. And then as we keep going to the east, we're starting to get into Tower. So if we start developing our infrastructure as we go east into Tower, that's going to make it a lot more economic, because the cost structure is going to come down. And in Tower, there are probably about another 40 locations in that range.
I saw with the quarter that you guys had drilled some of the longest wells, 2 of the longest wells that you guys ever had in your company history. So should we be expecting some more news around them next quarter once they're completed, or will they just blend in with everything else?
Yeah. So what we typically do is give averages. So
right.
We won't talk too much about the individual wells, but we'll give like the 7-well average kind of thing, because what we're doing is we're drilling in 2 different zones there. We're drilling in the A and the B, and they're both different in terms of what the prospectivity and productivity will be out of those zones. We sort of combine it all. But we are this 414 pad. It's quite exciting for us that we're currently drilling. We've set some pace setters on. We drilled one of the wells. It was about 5,500 meters in 7 days. So very, very quick, and we're very happy with the technology they're using, and more importantly that we're finding. I think the whole industry finds in the US they do the same, but that you really need to stay in the zone that you're targeting, and because the things just go better. You drill faster, you frack the wells easier. There's a lot of positives about it.
Okay, well, those are all my questions. So if any more come in, I'll email them to you guys. offline. But, thanks so much for coming on and for chatting to our network. We haven't really talked to many of the oil and gas companies over the past year. Everyone's been pretty quiet, but it looks like, it's definitely more of an upbeat market going forward. And so it is nice to get updates, and we think there is a lot of opportunity in the sector, and especially in some of the small cap names, because people just aren't watching them as closely anymore, which is always interesting, from our point of view, to try and, get stories out to the market.
Well, thanks for getting in front of it. I think this is a great idea. So hopefully we get some interest out of this, but we agree with you that it's been a while and the interest seems to be coming back.
So yeah, no, definitely. And so thanks everyone for listening. And if anyone was wondering what kind of wine Rafi was Googling at the beginning when he didn't realize he was sharing his screen, he says it was some Burgundies from a producer called Ampu, and it's all 90s vintages. So if anyone's looking for some wine recommendations, but thanks a lot for listening. And if anyone wants to, follow up with Crew or Kelt or Rafi, if you want Rafi's presentation, just email me and we will send it out. And then we're happy to get you in touch with the management teams that presented. Unfortunately, Surge did have to cancel last minute due to their financing. But yeah, thanks again. Thanks, guys.
Thanks, Victoria.
Thanks.